Hello, everybody. Today we are going to talk about accounting. For all of my students who want to be accounting majors, that is awesome. I've said this before in this course, I will say it again, and I say it in virtually all my courses. And that is, I love my students who want to be accountants. And why do I love my students who want to be accountants? Because accounting is, well, quite simply, I really don't like it. And even when I was a chief financial officer, um, I wasn't an accountant, which is unusual that you can get to that level of an organization in finance without actually being an accountant. Yes, I was a little different that way. So, if you want to be an accountant, that is awesome. Love you guys. And if you don't want to be an accountant, it is important to understand enough about accounting in order to be able to ask the right questions. So when you do take your full accounting course, please pay a lot of attention in it because it is important. It is how we judge business. It's how we know what's going on. We need the information from the accountants in order to understand what is really happening within our business. So, super important subject, and let's get into it. So, we're going to look at the role of accounting and financial information and the importance of it to stakeholders. I said it's paramount. It really is. We really need to understand what's going on there. We'll look at some of the different disciplines within accounting, which is interesting because there are a lot of avenues you can go down as an accountant to learn different things. We'll look at the accounting cycle. We'll look at the difference between accounting and bookkeeping. And we'll look at what's going on with computers and how that's shifting accounting. Some of you may have heard that within 10 years, artificial intelligence is going to replace most of the accounting that's done. That's awesome. Does that mean we aren't going to need accountants anymore? No, we are going to still need accountants, but the nature of the work that accountants do will be shifting. Okay, so there will be a shift in the nature of how accountants operate. Um, some people will be able to adapt and some people won't. You, as you're going into this, will be part of that transition, which is pretty exciting. It's always exciting to be part of a transition. We'll look at the basic financial statements and what they have to offer. And if we have time, we'll look at a little ratio analysis. So, accounting. What is accounting? Accounting is the recording, classifying, summarizing, and interpreting of financial events. It gives management and other stakeholders the financial information we need to make good decisions. Okay, so the recording, classifying, summarizing, and interpreting financial events to provide management with the information that they need in order to make decisions. Okay. Financial transaction is the buying and selling of goods, services, acquiring assurance, paying employees, using supplies, anything that involves money. An accounting system is the method used to record and summarize whatever data we have and produce whatever reports we need. So, an accounting system. First of all, there are inputs into our system, right? We need information in the accounting system in order to be able to work with it. So, where does that information come from? Well, it can come from sales documents, purchasing, shipping, payroll records, bank records, travel records, entertainment records, anything that involves money changing hands or assets changing hands. Uh, Processing, that is another part of our system. Okay, so what we do with that information is we get those inputs and then we make entries into journals. That's the recording of the information. Okay. What happens after that? Well, the journal entries are then transferred, or it's called posting, to the ledger. And that is classifying of the events. And then lastly, all the accounts are summarized. What do we mean by that? Well, um, we have an expense account for, I don't know, lunch. You work for a company that buys you lunch. That is possible. It still happens. I work for a company that would routinely buy me lunch. It would buy me lunch every day, right? So what happens? Well, I submit a receipt. It says lunch, $10. Um, it goes into an expense category called food, perhaps. And then what happens is all of my receipts go under food. And then what do? They aggregate my food receipts with everybody else's food receipts. And at the end of the month, they can say, hey, we spent this much on food. Okay. And so they do that with all the different types of accounts. Okay. And at the other end of the accounting system, we have our outputs. These are things that we need, the information we need in order to be able to make decisions. So we have our three basic financial statements, our balance sheet, income statement, and statement of cash flows. But those aren't the only things that we get through our accounting system. We get other types of information as well. Okay. We get financial reports, we get management accounting reports, we get ad hoc reports. If we want to know something that's going on, we can ask the accounting department to produce a report specifically around a certain thing. So accounting does a lot, and it is very informative. So who are some of the users of our accounting information? Okay, first of all, government, tax, right? We can't get away without paying tax. We need to submit our taxes on a yearly basis at minimum. If you're a company, it is most likely quarterly or more frequently, even monthly in some cases, that we need to submit information to the government. What else? Government regulatory agencies. Certainly, if we are in something like pharmaceuticals, they're heavily regulated. They require certain reports about how much we spend. Things like research and development and things like that. Who else? Other stakeholders. These are people who are interested in our company for whatever reason. Okay. Certainly, stakeholders would include owners. Well, if it's our company, yes. Creditors, people the company owes money to. Financial analysts, definitely if you're a publicly traded company, financial analysts will be interested in you because they want to see how you're doing. Certainly suppliers are interested as well because they want to know if you're a good credit risk. Everybody from the bank to anybody who supplies you raw materials or anybody in between, people who supply your furniture, right? They want to know that you are in a financially stable position. So what kind of reports do we have to give them? Well, certainly if we're a publicly traded company, many of our reports are already public. Things like our financial statements. Okay. Certain organizations may ask for more detailed, and we may be legally required to give it to them, or if we don't give it to them, we won't get what we need out of them. So we are legally required to give information to the government, regulatory agencies, those things, and things like the bank. If we are asking for a loan, if we're asking for a line of credit, things like that, they may have some more requests beyond just our initial financial statements. The last group on this list is the managers of the firm. Okay, we need to separate something here: owners and managers. Okay, sometimes they're the same, sometimes they're not. Certainly, if you own stock in Google or Apple, you are an owner of Google or Apple, but you are not a manager. As owners, we hire managers to run the company. Okay, so as an owner, what do we do if we own Apple stock or Google stock? We vote for the board of directors. The board of directors is there to represent us. The board of directors hires the CEO, the chief executive officer, and then the chief executive officer hires other managers in order to run the company. They run the company on our behalf. One of the major goals of their job is to increase the wealth of the shareholders. We are the shareholders. We are the owners. They want to increase our wealth. What does that entail? That involves making decisions that is in the best interest of us and to increase the value of the company, which is reflected in the stock price. This is the exact reason why I evaluate you in the CEO game on the stock price. It is the major or one of the major goals of the corporation is to increase the wealth of the shareholders. Okay. And we do that by increasing the stock price. I'm going to pause it here for a sec. Excuse me. Thank you. Didn't want to cough on camera. So what happens? Well, we can have what's called an agency problem. Okay. So we hire the CEO and the management team to run the company on our behalf. Okay. They are our agents. They represent us. They represent our interests. It is their job to make sure that they are operating the company representing our interests. Okay. So what happens if they don't? Then we have what's called an agency problem. Okay. They are not representing us anymore. What are some instances where this can happen? Well, if the management is incentivized to increase sales, then they may increase sales, but not always in a way that is in our best interest. And say, well, wait a second, aren't sales good? Well, yes, sales are good. Revenue is good. The problem is in a lot of companies, if we incentivize sales, that's what people will focus on is selling. And in, for instance, software sales, big software sales, millions of dollars worth of software sales that big companies buy, sometimes the salespeople will make the sale and get their bonus, but they will sell what in the software industry is called vaporware. They will sell stuff that doesn't actually exist. Or they will tell people, oh, yes, that's coming out next week or next month or whatever, and it's not. So in those cases, then it is not in our best interest as the owners. Okay, that's where we have agency problems. So what type of disciplines are there within accounting? Okay, managerial accounting, financial accounting, compliance, tax accounting, government and not-for-profit accounting, public and private accountants, and various types of accounting designations. Chartered accountant, certified general accountant, certified management accountant, and there has been some shift in that in Canada. In the United States, they're starting to parallel the same types of shifts. So, Sarbanes-Oxley. This is an interesting place for Sarbanes-Oxley. So, what would happen in the past is accounting firms would provide a lot of work for companies. For instance, an accounting firm would provide consulting work. They would come in and they would help you organize your accounts so they made sense for your company. They might help you with other accounting related things. They might advise the company. Then some of the other things they would do is they would also audit the company. Okay, an audit is a independent analysis of how the accounting was done. Okay, if you are a publicly traded company, you are required to be audited. If you are a startup company, an entrepreneurial company that has received venture capital from a venture capitalist, chances are they will want to have your accounting audited even before they invest in you. But they will definitely want to have you audited after they invest in you. Okay. So why is this a problem? Well, this is could be a problem if the people doing the consulting work and the advising work are also the same people who are doing the audit work. Okay, how did this come about? Well, this came about from some very high profile accounting scandals. One of the biggest ones was Enron. You might have to Google that one, Enron. This caused all kinds of repercussions around accounting. So as a result, the Sarbanes-Oxley Act came out that separated the consulting and non-audit work from the audit work and strengthened the protection of whistleblowers who said, hey, something's going on here that you guys really need to know about. Okay. It also required the CEO and CFO, the Chief Executive Officer and Chief Financial Officer, to certify the accuracy of the financial reports. And if they misrepresent those reports, there are stricter penalties. Okay. It also stopped the company making loans to the executives or the directors of the company. And it established a public company accounting oversight board under the Securities and Exchange Commission. This is an American act. Okay. One of the things to know is that as a Canadian company, as a Canadian public company, chances are you have American operations. So Sarbanes-Oxley may have an impact or will have an impact if you have American operations. One of my companies was a venture capital backed company. We were not public, but we did have an American subsidiary, and we were subject to Sarbanes-Oxley as well as a small company that had an American subsidiary. Okay. It also, and kind of wonder why this wasn't around before, but it stipulates that altering or destroying key audit documents will result in criminal charges and criminal penalties. Again, this came directly out of the kinds of fraud that had happened surrounding situations like Enron. Okay, so Sarbanes-Oxley has tightened the requirements of management around accounting. So, an accounting cycle. The accounting cycle is a 6-step procedure which results in the preparation of the major financial statements. Bookkeeping is just the recording of those business transactions. A journal is the record book where the accounting data are first entered. So, what are the 6 steps in the accounting cycle? First, analyze the source documents. Okay, we receive information in a variety of ways. Sometimes it's in paper, sometimes it is electronic, sometimes it has supporting documents. So we need to make sure that it has the required information that we need. Okay, we record those in our journals. Okay, so we take it and we put it into the journal. Then we put it into the ledger. That's also referred to as posting it to the ledger. Okay, remember that's where the classification happens. Then we do what's called taking a trial balance. Okay, when we have an accounting system, it has 2 parts to it and it needs to balance. Okay, so we take a trial balance to make sure we didn't miss anything. The numbers should add up. Okay, then the 5th step is to create our basic financial statements, the balance sheet, income statement, and statement of cash flows. And then lastly, we can use those for analysis. So, financial statement. Basically, it is a summary of the transactions that have occurred over a specific period. Okay, over a specific period. This is important in accounting, is we need to understand how the periods work. Okay, and I'll get into the details of that when we get to the statements in more detail. Okay, so a balance sheet. A balance sheet reports our financial condition at a specific time and has assets, liabilities, and owner's equity. Those are the 3 major types of accounts: assets, liabilities, and owner's equity. You need to be very familiar with those. An income statement shows what we've made as a profit after our cost, expenses, and taxes. Okay, it shows how much revenues come in. It shows our costs and related expenses and taxes. And the third one is our cash flow statement, and it reports on cash receipts and disbursements related to the 3 major activities of the firm. And lastly, liquidity is a word you need to know, is how fast we can turn an asset into cash. Okay, how fast we can turn an asset into cash, liquidity. Okay, let's take a couple examples. If I have cash in my pocket, That's very liquid because it is cash. Zero amount of time it takes me to turn that into cash. If I own stock, I can go on my phone and make a trade. I can sell the stock, and the cash will show up in my account either late tonight or tomorrow morning, depending on what kind of broker you have or what kind of investment it is. It could be a little longer. For instance, if you own a mutual fund, you could potentially sell that mutual fund and it could take up to a week, 10 days for the money to show up. Okay. Again, the length of time it takes before the cash is available. And lastly, let's look at a building. Okay. If I wanted cash out of a building, if I wanted to sell the building, how long would it take me? Well, I'd have to put it up for sale. I'd have to wait for somebody to see it. They'd have to make an offer. The offer would be conditional on a multitude of things, a building inspection, financing, things like that. So if I wanted to sell the building, I could put it up for sale today, and I might have to wait months or years even in order to get the cash. So a building is not very liquid. A stock is much more liquid by comparison. So basic bottom line, the accounting equation, assets equals liabilities plus owner's equity. Fundamental principle of business. Okay, assets equals liabilities plus owner's equity. And this is how we start with the balance sheet. Okay, this is the basis of the balance sheet. I talked a little earlier about doing the trial balance. Well, the trial balance, the numbers should be equal because we use something called double entry bookkeeping. Okay, so what's the concept of double entry bookkeeping? There are credits and debits. And every time you do something in bookkeeping, it goes into at least two accounts where the credits and debits need to add up. Okay. So the different types, assets, liabilities, owner's equity, much like the fundamental accounting equation, right? So the trial balance, basically we look at all of the credits and the debits from the ledger, and we make sure that they are matching balance. So let's look at a accounting sheet or a balance sheet here. We've got a company called Harvest Gold, and one of the things that is interesting is the dates. I told you about the dates earlier. So one of the things you'll see on a balance sheet, which is a little different than the others, is a balance sheet is a moment in time. So it gives us the relationship of assets equals liabilities plus owner's equity at a specific date in time. Okay, so Harvest Gold balance sheet as at December 31st, 2018. Okay. So our assets, these are things we own, things that have value. Our current assets are cash, accounts receivable, notes receivable, and inventory. The one you may not be as familiar with is notes receivable. Okay. So this a note is a type of investment. Okay, so we have $50,000 in investment that we expect to get back. Accounts receivable is money that people owe us. So this is money that people have bought our product and haven't paid for yet. Cash should be self-explanatory, as should inventory. Other assets we have land. We have building and improvements. We have depreciation. So we paid building and improvements of $200,000. We had $90,000 in depreciation, which nets out to the 110. We had equipment and vehicles worth $120,000 minus the depreciation, because we know things depreciate over time, to give us a net of $40,000. We have furniture and fixtures, again, things inside our building, and $10,000 in depreciation there for net of 16. So we have $206,000 in total fixed assets and $600,000 in total current assets. We also have intangible assets. Intangible assets are things we can't touch, like goodwill. Okay. Our name, Harvest Gold, means something. So we have $20,000 worth of goodwill. You'll get into much more detail about that in your accounting course. So that is our asset side at $826,000. Let's look at the other side of the equation. Assets equals liabilities plus owner's equity. Well, we have current liabilities. Current liabilities are those that are due in the short term. We have accounts payable of $40,000. That is money we owe people. We've bought some product from them. We have the product. We haven't paid them yet. We have notes payable, much like the notes receivable, where we had an investment and we're expecting that money back. We have notes payable. This would be where somebody has paid us and we are giving them their interest. Okay. We have accrued taxes up to this period in time. We have salaries that have accrued. We have 288,000 current liabilities. We have long-term liabilities, notes payable of $35,000. So what does that mean? Well, remember I said we got money as an investment from somebody else and had the notes payable of $8,000. Well, that payable due June 2019 could be an interest payment on that March 2023 note payable that we have to give the $35,000 back. We also have bonds payable. A bond is another investment vehicle. And so we issued bonds that were purchased by other people, and we'll owe $290,000 at 2028. So our total long-term liabilities are $325,000. Our current plus long-term liabilities are $613,000 total. Our owner's equity, we have 1 million shares, and the value of the 1 million shares was $100,000. We have $113,000 in retained earnings, and our total owner's equity and liabilities, when you sum all of those, is $826,000, which, as you can see at the top of the page up here, matches our assets. Assets equals liabilities plus equity. So liabilities, what we owe to other people, are debts. Okay. Accounts payable is a current liability that we owe for stuff that we bought. We went through a bunch of this. Notes payable, short-term or long-term liabilities that we promise to repay by a certain date. Bonds payable are long-term liabilities that represent a loan to us that we have to pay back under certain conditions. You'll learn about this in finance class. A bond is, in essence, a loan with a specific type of repayment period. Okay, so it is nothing more than a loan that scopes out exactly how that loan will be repaid, not replayed. Repaid. Okay, and lastly, taxes payable are taxes that we may have collected. Provincial sales tax, goods and services tax, harmonized sales tax. There's taxes in every country almost. How many are there? I believe there are 9 or 13 jurisdictions in the world that don't pay income tax or different types of taxes. So in most countries, there is income tax payable. So here is our income statement. So we went through the balance sheet, which was at a specific date, which was as at December 31st, 2018. That is how our assets, liabilities, and owner's equity looked on the 31st of December, 2018. Okay. An income statement is over a period of time. So you can see at the top here, it says for the year ended December 31st, 2018. Okay. So what does that mean? That means for the financial year, which in this case runs from January 1, 2018 to December 31st, 2018. This is what happened. Okay, gross sales, $720,000. Now, it makes sense when dealing with things like sales, right? So you notice in the balance sheet, we didn't talk about sales. We talked about assets, liabilities, and equity, right? A point in time makes sense for that. Because guess what? At a point in time, I know I own that truck. Tomorrow I sell that truck. That's different. Okay. So if I sell the truck tomorrow, that will have an impact on my cost structure. So that would show up in an income statement. All right. But as of today, I still own that truck. So it shows up on the balance sheet. Okay. So remember, balance sheet, point in time, income statement over a time period. The most common time periods you will see are yearly, quarterly, and monthly. Okay. So revenues, $720,000, less returns and allowances. Returns, people bringing stuff back. Allowances come from the fact that we know over time that we get X% on average back. Okay, so we just build those in. So we're not shocked and surprised when that comes back later. Discounts, we've offered a discount. So what do we have? We have our gross sales minus returns and allowances minus the discounts, which nets us out over here on the right to $700,000. Okay. What else? Our cost of goods sold. So we had our beginning inventory on January 1 was $200,000. We bought $400,000 worth of stuff. We paid $40,000 in freight. So our net to buy that was $440,000. Our cost of goods available for sale was $640,000. Okay, so we had $200,000 in inventory. We added $400,000. We had to pay 10% shipping, so we have $640,000 total of goods available for sale. Okay, so what happened at the end? We sold $230,000. So our net for this account is $410,000. Anybody see a problem with this? Some of you might have experienced this in the CEO game, right? We have more inventory at the end of the period than we did at the start of the period. We made too much, we bought too much, we didn't sell enough. So we've got excess inventory. It's the value of our inventory. Okay, so our inventory at the start of the year was $200,000. We added $400,000, $440,000, including the shipping. So the cost of goods available for sale was $640,000. Our inventory at December 31st was down $230,000, which means our cost of goods sold was $410,000. Okay, which leads to our gross profit. So we sold $720,000 less our discounts and returns and allowances. So that's 700 minus the cost of goods sold at 410 leaves us at 290. Now, our operating expenses. We had expenses. We had salaries for salespeople, advertising, supplies. Those are our selling expenses related directly to selling. So that was $110,000. We also had some general expenses of office salaries, depreciation, insurance, rent, light, heat, power, miscellaneous of $112,000. These are often referred to as SG&A, selling, general, and administrative expenses. So those total $222,000. So we take our revenue minus our cost of goods sold minus our SG&A, and we are left with net income before tax of $68,000. We then take away our tax and wind up with our net income after tax of $49,000. Okay. So our last statement that we're going to go through here is the statement of cash flows. Okay. The first thing you'll notice is the date. Again, cash flows, so we can picture stuff coming in and coming out. Again, this is for a time period for the year ended December 31st, 2018. So from January 1, 2018 to December 31st, 2018. Again, like with the other statements, the three most common timeframes you will see are yearly, quarterly, and monthly. And generally, when you see one statement, you see all three. Okay, so generally, I would expect to get an income statement, a cash flow statement, and a balance sheet all at the same time. And the balance sheet would have that point in the sand. Okay, so what do we have? We got $700,000 in cash from our customers. We paid out $567,000 in cash. We paid $64,000 in interest. We paid $19,000 in taxes. And we were, we got $2,000 received from one of our investments. So our net cash provided by our operating activities was $52,000. That's over here on the right. Okay. So we had other things that we did as well. So we've got operating activities. That's the running of our company. We had investing activities. Okay. So from an investment perspective, what did we do? We sold some assets. It says proceeds from sale of plant assets. Machines, probably. So we sold a machine for $4,000. But we also purchased a new machine. It looks like payments for purchase of new equipment for $23,000. So the net cash on that 23 minus 14 is negative 19. We also had some financing activities. So we received $2,000 from the issuance of short-term debt. Okay, so we took on a short-term loan of $2,000. We had to pay $8,000 in long-term debt. Okay, so that could be a bank loan, that could be a note payable. And we paid $15,000 in dividends. Okay, so the dividends would have gone to our cash or our shareholders. And so the net cash flow from financing was negative $21,000 operation, or negative $21,000. Okay, so what does this mean? Well, we add up all of those cash flows. We had cash flow from operations of plus 52. We had negative cash flows from investing and financing of minus 19 and minus 21. We net that out to plus 12. So we made $12,000 in cash at the end of the year. Remember, this is cash. Okay. So what happened? At the beginning of the year, we were left down $3,000 from the previous year. So we had $15,000 in cash at the end of the year. So we had a net change of $18,000 in cash. Okay. So we are on to ratio analysis. Ratio analysis gives us information that we can use to assess the performance of the company and compare it. Okay, I'll get to these metrics in a minute and what metrics mean. So basically, we look at various ratios. Most of the information for these ratios comes from our financial statements. Common ratios are liquidity, debt, performance, and activity ratios. And we'll briefly bang through all of these. So when we have metrics, how do we use them? Well, if somebody told me your liquidity ratio was X, I'd say, oh, that's interesting. And I'd say, what does that mean? Well, unless I know enough about the company or enough about the industry, I might have a hard time understanding what a single liquidity ratio means. So how do we use these? Whenever we have a metric, we use it to compare us versus ourselves, and we use it to compare us versus our competitors. Okay. So we can look at any ratio and look at what's happened over time with our company. Is it stable? Is it changing? Is it getting better? Is it getting worse? That gives us an idea of how we are doing within our company. But we don't just want to know how we're doing within our company. We want to know how we're doing outside of our company. So I can look at a ratio or a metric and I can compare it to my competitors. Am I better or worse than them? Has something changed with their company that caused them to be better or worse? Okay, so getting a single number isn't necessarily that helpful. Understanding that number in context is much more helpful, right? Look at the history of our company. How has that ratio changed over time? Look at how our company's current ratio compares against the current ratios of other companies. I hesitated using current ratio there because current ratio is an actual metric we can use, right? But by current in that case, I mean the current result of those ratios. Okay. So, come on. Let's get into the balance sheet and income statement accounts. Okay. So we talked about different types of accounts. We talked about classifying the information that comes in. Okay. So where do each of these types of accounts show up on our financial statements? Okay. Let's start at the far right. Okay, with expenses. Okay. These are types of expenses: wages, rent, repairs, travel, insurance, utilities, entertainment, storage, taxes, advertising, supplies, fees, licenses, donations, interest. These are expenses, and they would show up on our income statement. Cost of goods sold on our income statement, cost of buying goods, and cost of storing goods. Right? Remember from the CEO game, if you have inventory left over from period to period, it costs us to store goods. Something good to know if you are planning on using Amazon as a fulfillment partner. If you ship a pallet of inventory to Amazon, they will charge you every day for that inventory sitting there. So if your inventory isn't moving, Amazon will charge you a lot of money. Okay. Need to build that in. It's an expense. Let's jump all the way over to the left on the balance sheet side and look at our assets. Okay. Assets: cash, accounts receivable, inventory, investments, equipment, land, buildings, motor vehicles, goodwill. These are assets, things we own that have value. Liabilities are things that we are indebted for. Accounts payable. Remember when we buy something and don't pay for it right away, we have an account payable. Remember when we sell something and we let somebody pay us back 30 days later what they owe us? That's an account receivable. If you have a credit card, you have an account payable if you use it. Okay. What else? Notes payable, bonds payable, taxes payable. Again, things we owe people. Owner's equity. What things fall under owner's equity? Stock, shares, the ownership of the company. Retained earnings. What are retained earnings? Retained earnings is the money that is left over after we've paid everything. Okay. on the financial statements, you saw retained earnings there. I hope. I'll have to go back and check. Hang on. So you saw retained earnings back on the balance sheet. Common stock, treasury stock, different assets, or different, sorry, not assets, different types of stock will show up here. And lastly, revenues. We can have revenue from different things: sales revenue, rental revenue, commissions, royalties, various things would show up here. So there can be lots of different accounts. Okay, this is just a sampling. This is by no means an exhaustive list. So that was accounting in a nutshell. Okay. We need to understand the basic accounting statements in order to understand and run our businesses. We can't get away from it. Okay. So it is good to take your accounting class seriously when you get to it, whether or not you want to be an accountant. And I will also say it's as important, if not more important, for finance as well. And we'll get into that in the next chapter. Right. So we need to understand how the money flows through a company. Okay. So there's lots of different areas of accounting. Managerial accounting. Managerial accounting is closer to finance. That is probably the closest we get to finance. Managerial accounting is dealing with all of the information and using it to make decisions. Financial accounting is what many people think of when they think of accounting. It's the financial statements, which are generated by financial accountants. Okay? Compliance accounting is making sure that we meet the regulations, that we are doing our accounting in an appropriate manner and meeting all the government regulations surrounding that. Tax accounting, huge group of accountants are tax accountants, both for private citizens as well as for corporations. When we look at taxes, everybody's goal is essentially the same thing: to pay as little tax as possible. Okay. And so in complex situations, very often we need tax accountants to help us out. Government accounting is working within the government. That can be in a place like Revenue Canada, or it could be in any department that needs accounting for that. Not-for-profit accountants are those people who work with not-for-profits and are very well versed in the rules surrounding what is required of a not-for-profit to maintain that not-for-profit status. Okay. Accounting cycle, analyzing the documents, recording the information into the journal, posting that to the ledger, and that's where the classification happens into which account it goes into. That is posting it to the ledger, developing a trial balance, preparing the financial statements, and then lastly, analyzing them based on ratio analysis and things like that. 3 basic statements. Balance sheet reports the financial position of a firm at a point in time. Okay, on this date, this is what the company looked like from a financial standpoint. The income statement expresses what has gone on with our revenues and expenses over a time period. Most common time periods are monthly, quarterly, yearly. Okay. Cash flow statement identifies the differences between cash receipts and outlays, again, over a period of time. Okay. One of the things that is a requirement of publicly traded companies is the release of their financial statements. So if there is any major company you've heard of that is traded on a stock market, you can go and pull down their statements. They are required to release their statements on a quarterly basis. So every 3 months, they will release their statements for a period ending at some point in the last couple months. It takes a while to prepare these, and the bigger the company, the more accounts you need to work on them, right? So if your quarter ends on March, at the end of March, right, it might not be until May, possibly June before the company releases that information. And they will say, these are the quarterly financial statements for the period ending March 31st. And you might not get those till May or June. Okay. Monthly statements you generally won't see out of public companies. Monthly statements, they are generated every month, but they aren't necessarily released to the public. And lastly, ratio analysis looks at where we stand from a financial standpoint based on these various types of ratios. Okay, but we want to make sure that when we look at a ratio, we are given the proper context. We understand the proper context. What is the context? How we are doing against ourselves. Has this ratio gotten better? Has it gotten worse? What's happened over time? Which way is it trending? And then we look at how we are doing versus our competitors. Are we in a better position? Are we in a worse position? Is their ratio changing? And then we can look at why and what's going. That said, everybody,